Hey everyone, and welcome back to the channel. Today is January 17th, 2026, and we are diving deep into a market that's absolutely buzzing right now. Silver. Forget everything you thought you knew, because in 2026, silver isn't just a shiny metal you hold in your hand. It's a strategic industrial powerhouse, and savvy investors are shifting their focus from physical bars to more dynamic, liquid paper assets. Let's break down what's happening and where the opportunities lie. First up, let's talk about ETFs, or exchange-traded funds. For most U.S. investors, this is the easiest and most popular way to get into silver without the hassle of storing physical metal. The king of the hill here is the iShares Silver Trust, ticker symbol SLV. This is the largest, most liquid silver ETF on the planet. Right now, we're seeing massive inflows into SLV. That means big money, especially from institutional investors, is flooding in to hedge against inflation. The beauty of SLV is its simplicity. It tracks the spot price of silver almost perfectly. So if you believe silver is heading towards that magic $100 mark, SLV is designed to follow right along with it. But what if you want a little more juice? That's where the Global X Silver Miners ETF, ticker SIL, comes in. This fund doesn't hold the metal itself. Instead, it holds a basket of silver mining companies. This is what we call a leveraged play. Here's how it works. When the price of silver goes up by, say, 10%, the profit margins for mining companies expand dramatically. As a result, their stock prices can jump by 15 or even 20%. It's a higher risk, higher reward strategy for those who are bullish on the entire silver sector, not just the metal. Now let's zoom in on individual mining stocks, because this is where the action is getting really interesting. In 2026, many top-tier miners are actually outperforming the metal itself. Why? Because they've become incredibly efficient. Their operations are humming, and they're rewarding shareholders with rising dividends. Let's look at the big names trending on the New York Stock Exchange. First, you have First Majestic Silver, ticker AG. They're often called the purest silver play because a huge portion of their revenue comes directly from silver. While their mines are mostly in Mexico, their NYSE listing makes them easily accessible for U.S. investors. Next is Pan American Silver, ticker PAS. This is an industry giant. Investors love PAS for its stability and its diversified portfolio of mines spread across North and South America. It's seen as a safer, more established choice in the mining space. Then there's a name that's especially relevant for American investors, Hecla Mining, ticker HL. Hecla is the largest silver producer in the United States. With major operations in places like Alaska and Idaho, it's considered a low-risk option from a geopolitical standpoint. In a world of uncertainty, owning a piece of a domestic producer is a very attractive proposition. Finally, we have a different kind of company altogether, Wheaton Precious Metals, ticker WPM. Wheaton is a streaming company. This is a fascinating business model. They don't operate any mines themselves. Instead, they provide upfront capital to mining companies in exchange for the right to buy a portion of their future silver production at a fixed, low price. This model makes them incredibly profitable during bull markets like the one we're in now, and it insulates them from the operational risks of mining. So that covers the what and the how. Now for the most important part, the why. Why is everyone in the U.S., from Wall Street to Main Street, talking about silver right now? The first massive driver is the AI infrastructure gap. Every single AI server, every high-speed semiconductor that powers our digital world requires silver for its unparalleled electrical conductivity. The U.S. tech boom isn't just about software. It's creating an insatiable physical demand for silver, and that demand is only growing. The second reason is a classic supply and demand story: inventory depletion. The registered silver inventories at the major hubs, the COMEX in New York and the LBMA in London, are at 20-year lows. We are seeing real physical tightness in the market. There just isn't a lot of deliverable silver available. This situation is scaring short sellers, those who bet on the price going down. As the price rises, they are forced to buy back their positions to cut their losses, which adds even more fuel to the fire and pushes prices higher. The third factor is the gold-to-silver ratio. This is a classic metric that compares the price of gold to the price of silver. Historically, the average is around 80-1, meaning it takes 80 ounces of silver to buy 1 ounce of gold. Finally, let's look at the charts and talk about the key technical levels every trader is watching. The major line in the sand, the big resistance level, is at 95 Wassersaurs an ounce. If silver can decisively break through and hold above this price, the path to the next major psychological target of 100 points is wide open. A break above 95s would likely trigger a wave of new buying. On the downside, we have very strong support at $82.50. If the price were to dip, we expect a lot of buyers to step in aggressively at this level, viewing it as a major buying opportunity. These are the critical battlegrounds that will likely determine silver's next big move. So there you have it, a complete picture of the silver market as we see it in early 2026. From ETFs and mining stocks to the powerful drivers of AI demand and dwindling inventories, the story for silver is incredibly compelling. The dynamics are shifting, and the opportunities are clear for those who are paying attention. As always, do your own research before making any investment decisions. Thanks for watching today's update. If you found this breakdown helpful, make sure to hit that like button, subscribe to the channel, and ring the bell so you don't miss our next market analysis. I'll see you in the next video.